Well, let's head over to Zimbabwe now, where gold miners are due to meet the Ministry of Finance on Wednesday, and that's to find a solution to a foreign currency allocation, which, of course, are threatening their viability. Now, gold producers have warned that some mines may be forced to suspend their operations due to the currency shortages, and CGTN's Farai Mwakutuya looks into that further.
As of the beginning of October, Zimbabwe's gold mining companies have only been allowed to retain 30% of their foreign currency export earnings, an amount they say isn't enough to cover costs. The rest is credited as bond notes, whose official value is the cause of the problem.
One thing that was going to work was if the government, if Reserve Bank had abandoned the exchange rate peg in good time. Because all these challenges are coming as a result of the fact that we have got an exchange rate, an artificial exchange rate of cash US dollar, nostro US dollar to electronic US dollar and bond notes at par 1:1, which is no longer the situation reflective of what is happening on the ground.
The disparity has driven up local costs exponentially. It means some miners may be forced to shut down, an ominous sign for Zimbabwe's fragile economy.
This leads to issues such as smuggling, as these people try to survive, try to get better prices from obviously gold dealers. So it has got far-reaching consequences in the foreign currency generation capacity of the country.
The government is in a catch-22 situation.
It relies on limited foreign currency inflows from exports like gold to keep the country going and is targeting more production to grow the economy. But if it keeps taking from the miners, then it risks killing the geese that are laying the golden eggs.
The Gold Producers Committee has secured a meeting with the Treasury for talks that could make or break the sector. Members want to retain a larger share of their export proceeds, a proposal the government may not readily accept, especially at a time it's facing increased demand for foreign currency to stabilize the supply of fuel, basic commodities and medicines. Farai Mwakutuya, CGTN, Harare, Zimbabwe.